two best quality stocks to buy in the stock market right now. This is a video that I do every single month talking about the two best quality stocks to buy. And I actually own both of those companies. One of them I bought very recently. I'm going to share all of that in the video. It's something that I don't do very often. So all I ask from you, if you could please press the like button if you do enjoy it, and maybe consider subscribing. Okay. Now the first one, which I talked about a lot, and I'm going to keep it very short because I did so many videos. And this stock is Uber. And it feels great for someone like Bill Ackman to recognize the opportunity in Uber. You know, I've been talking about it for a while, and it's amazing. And he did announce that in beginning of January, he has a stake in Uber of over 30 million shares. That's a lot of shares in a company like Uber. And he said, we believe that Uber is one of the best managed and highest quality businesses in the world. Remarkably, it can still be purchased at a massive discount to its intrinsic value. This favorable combination of attributes is extremely rare, particularly for a large cap company. And I'm gonna talk about the intrinsic value of Uber in this video and do a very quick overview as I talked about the stock a lot, but the stock did go up on Bill Ackman buying Uber, but I still believe there's so much upside for the stock, and I believe this rally is permanent because now more and more investors will try to look into Uber, and they might realize the value of the company, which will likely close the gap between the stock and fair value of the company. Okay, and Uber, a lot of people, they have a bad memory about the stock. They believe it's just some terrible company losing money, and it used to lose a lot of money back in 2019, but the company now is completely different. They went from losing $5 billion in free cash flow to now about to make around $7.7 billion in free cash flow. This is a totally different business from what you've seen in 2019. Uber, even though it's a large cap company, they're still growing revenues 21%, and they're gonna likely continue growing revenues 21%. It's amazing. The delivery business is actually accelerating in growth. It's growing 18% in gross booking. It's accelerating. Revenue is accelerating from 4% to 20%. Adjusted EBITDA, it was 2.8% margin. Now it's a 3.6% margin. So you're owning a business that's actually accelerating in revenues, accelerating in profits. It's not decelerating. And you could still buy it at a discount, which is insane. And that's what Bill Ackman is talking about. Adjusted EBITDA up 44% year on year, massive improvements in adjusted EBITDA. Now the company has over 171 million people, 171 million users. They use them every single month. It's the scale is getting insane, and it grew over 10 million people quarter on quarter. This is just amazing for the company. But if you're buying Uber, you're not just getting Uber, you're also getting stakes in many amazing companies. One of them is Grab, which I believe is the Uber of Southeast Asia. They're rapidly growing in this region. So you get a stake in that. Aurora, which they mainly do a lot of the autonomous trucks, semi-trucks, and other things they're working on. You have Didi, which is a popular app in China, and other kind of equity investments in Joby Aviation. They do the air taxis and all the kind of things. So you get a lot of exposure. But the main reason why Uber has been going down, and this is why there was a gap between fair value and the actual price of the stock, is the whole thing with autonomous vehicles and the worry that autonomous vehicles, they're gonna kill Uber's business model. And although Uber does have a lot of partners like Waymo, which is one of the leaders in commercializing autonomous vehicles, other kind of companies, even Nvidia, they're working on a software for autonomous vehicles, and they're going to use Uber's data. They announced a partnership with Nvidia, and I made a joke that this is the only stock that has partnered with Nvidia, and it went down. It was just insane. But the main concern is Tesla, that Tesla is just going to kill Uber's business model, and that's very possible. This could actually happen. But the main thing is that first, Tesla is not going to have 100% market share. I always say that. But the second thing is, and this is what I believe will ultimately happen, is even though Tesla has its own app, they have their own ride-sharing app, the drivers will still likely list the car on Uber. The main reason they would do that is to get more reach, to get more exposure. Just like other restaurant apps, they have their own app, Pizza Hut or whatever. They still have their services on Uber Eats because of the network, because of the people, because of the logistics, because of how everything is so easy in terms of handling refunds, lost and stolen items, all these kind of things. But the biggest part that most people are missing is that Waymo is mostly going into new cities exclusively on the Uber ride sharing app. And this is what Waymo said. They said Waymo's own ride hail app, Waymo One, will not be operational in Austin. Customers who opens the Waymo One app will be redirected to Uber's app. And this is for a very good reason. Uber, I should say, Waymo, which is owned by Google, they have unlimited resources. They could easily expand their Waymo One apps. They could do all these things. But they're still choosing to partner with Uber. This is for a very good reason. Because Uber is not just the app. They also own stakes in fleet managers. The fleet managers are the companies that clean those cars, they charge them, they maintain them, they do all these kind of things. Do you think Google or Waymo, they want to deal with that stuff? They don't want to deal with that stuff. So Uber deals with that stuff. And ultimately, over the long term, once the cost per mile goes down a lot, Uber's business model in terms of autonomous vehicles is going to be extremely, extremely profitable. And that's not going to happen before 5-10 years from now. Like in terms of at scale, it's not going to happen anytime soon. It's going to take a long time for this to affect Uber's business model. But Uber right now is still trading at 20 times cash flow. 20 times cash flow is dirt cheap for the company. The mean was 24 times, as high as 32 and as low as 18 times. Now you could buy it still around 20 times cash flow, which is dirt cheap. Now this is my shorter term valuation model on Uber. Uber is expected to reach around $7.8 billion in cash flow in 2025. I personally believe this is conservative and it will likely end up being much, much higher. But I'm just going to take the $7.8 billion in cash flow at face value. Okay, and the mean free cash flow multiple was around 25 times. Now, if you look at Uber's margins, Uber growing 20-25% in cash flow, it should at least trade at one-time cash flow. One-time cash flow is 25 times cash flow. So I believe after the whole sentiment with Tesla taking over Uber and Uber going to zero kind of sentiment fades away, I would expect Uber to get back to its mean free cash flow multiple of 25 times. And I think that could happen as soon as 2025. Now, if that happens this year and Uber gets back to 25 time cash flow, this is $195 billion market cap. The current market cap is $157 billion, which is still around 24% on the upside this year alone. For a company like Uber, this is what Bill Ackman is talking about. The intrinsic value of Uber is around $100 per share. Now you can still buy it at $74. This is just for the short term. Over the long term, even from here, I would expect at least a 20% annual return on Uber, as I believe the total business, the free cash flow earnings per share, they will keep on growing at 20%. So the return of Uber stock will likely mirror free cash flow growth of around 20%, and that's excluding a multiple expansion. So the stock is still one of the best quality stocks in the market. It's still very cheap, and I don't think you're late on this one. And I do own a position, and I'm hoping to buy more in the future, even though I have to average up a little bit. But sometimes you just have to average up. And that's the first one. The second one, which I talked about a lot, I'm going to talk about it again. And I recently bought the dip around 214, which I don't share very often on YouTube. And this is Cheniere Energy. This is one of my stocks. I talked about it a lot. And it was doing very well year to date. The stock was up like 15, 16% in the first few weeks. And now the stock from all-time high is down around 14%. And it surprised a lot of you, and it surprised me a little bit as well. But this is what we have in the market. We have a lot of different overreactions. And I'm going to talk about why it's going down. But Cheniere Energy has the largest liquefaction facility in the United States, second one in the world. So they liquefy the gas and they ship it to many different countries, many different regions, like to Europe, they ship to Asia, they ship to Latin America, and they ship to other countries around the world from the United States. This is what they do. They collect a fee for liquefying the gas, and they don't have as much commodity exposure as most of you guys believe. And now this is a key area for the United States and for the whole NATO partnership for Europe in general, because we have a lot of things within tariffs war, and they want to raise tariffs on each other. And one of the ways to avoid it is to potentially be buying more US natural gas. And this is what the talks is happening with Europe, where Europe is ready to negotiate with Trump boosting natural gas imports from United States. They can buy more natural gas, and this way they would avoid a lot of the tariffs that could happen between the two nations. It's the same thing with Japan. Trump says Japan will soon begin importing more shipments of US natural gas. And this is a key trend that a lot of people are missing for energy security and also for the whole thing within tariffs, where if they want to avoid those tariffs, they're likely going to have to buy more of what the United States produces. And one of them is natural gas. And Cheniere Energy is like the toll bridge, the toll booth for that. They have to go through Cheniere Energy or through other kind of liquefaction companies for them to be able to ship the gas to Japan, to ship it to Europe, to ship it to all kind of places around the world. And it's just a beautiful, beautiful, very predictable business model. But I'm going to keep it very short. And for Cheniere Energy, they have something called their 2020 vision by 2027. The 2020 vision is they want to allocate $20 billion in doing buybacks, in doing dividends, and in even paying down the debt. And their goal is to purchase 10% of the market cap by 2027 to reduce the debt to 4 times EBITDA and to grow the dividend at a 10% growth through the mid-2020s to get to a 20% payout ratio. The second part of their 2020 plan is to get to $20 of DCF by 2027. DCF is distributable cash flow per share. Okay, and I'm going to talk about that soon. But the main reason why Cheniere Energy is going down is because there's talks that the war between Ukraine and Russia and all that is going to end. And that could be maybe, Russian gas will flow back to Europe and then Cheniere Energy will have no business. And I believe this could not be further from the truth. I just don't think it's going to happen. But even if it did happen, Cheniere Energy, as you could look over here, their long-term contracts are around 43 metric tons. So it's most of their output is actually secured in long-term contracts. And those long-term contracts, they last between 15 to 17 years. So most of their contracts are secured within long-term agreements. And the company's going to be fine no matter what. If they do increase capacity, they can ship more to Europe, to other things. But this is not the main thesis. The main thesis is for the company to continue what they're doing, to continue their expansion, which is going to get them to 20 DCF by 2027, and it will likely be much, much more than a 20 DCF. But just looking at the near-term valuation of Cheniere Energy, for 2024, their guidance is between 3.4 to 3.7 distributable cash flow. And 2025 will likely look much, much better because I told you guys that the output is increasing between 2024 to 2025. So it's likely going to look much, much better. But just using a near-term valuation model at $3.7 billion of distributable cash flow, this is around a 7.5% free cash flow yield. 7.5% free cash flow yield for such free cash flow growth, for such a company with a wide moat, with massive tailwinds between Europe, United States, Japan, Asia in general. It's just dirt cheap. It's very, very cheap for the company. And that's why I bought more of the stock. I averaged up around $214 per share. And that's how I look at it. But over the long term, by 2027, they should be able to get to the 20 DCF per share. Okay. And this is how I think about it. I take the 20 DCF by 2027 per share, which I believe is highly, highly achievable. They said they're 6 months ahead of schedule, and we time it by 20 times cash flow, which is the current multiple. I believe that's fair for the company. We get around $400 per share. The current price right now is trading at $217. This is over 84% on the upside over the next 2 years, 2.5 years. This is very, very cheap for the company. And it could be much, much higher. But even if we were wrong in this case, we get 50 or 60% in 2 years. It's not too bad. It's an amazing return. So that's why I've been buying more of Cheniere Energy. And I've been talking about it on YouTube since it was $160 per share. And I might buy even more in the future. And I share what I do in my own investment group. This is the link if you're interested. So thank you very much for watching. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.